If you're looking for a way to make some extra money in your spare time, trading vertical option spreads might be the perfect solution for you. Vertical option spreads are a type of option strategy that allow traders to profit from price movements in either direction. In this video, we'll discuss what vertical option spreads are and how you can use them to generate profits in any market. We'll also take a look at some of the risk and rewards associated with trading vertical spreads. So if you're interested in learning more about this profitable trading strategy, keep watching. We discuss what is a vertical option spread, how do you sell a vertical option spread, max profit, max loss, and break even, as well as the advantages of vertical option spreads. Real quick, please hit like and subscribe below, as well as comment and let me know your thoughts on the video. It really helps the channel. Also be sure and grab the free simplified options strategies trading guide. I'll put a link down below. It covers the different options strategies, setups, how and when to put them on, max profit, and trade management. It's a great guide to have by your side while trading options. So let's get started. What is a vertical spread? A vertical spread is the combination of a long option and a short option with different strike prices placed within the same expiration date. So when you trade a vertical spread, you are effectively placing two trades at one time. There are two types of vertical spreads, call verticals and put verticals. We're going to focus only on selling vertical spreads as opposed to buying them, since this is a much higher probability and we want to play the role of the casino versus that of the gambler. When we sell options, we collect time premium. We sell call vertical spreads when we are neutral to bearish on a trade and we want the stock to come down in price. We sell put vertical spreads when we are neutral to bullish on a trade and we want the stock to increase in price. How do we sell a vertical spread? Let's look on the Tastyworks trade platform. I'll put a link down below. It's the best platform for trading options, and if you use the link below, you will get a special offer when you open an account. So let's go to the trade tab and punch in the ticker NFLX. Netflix is down right now and it is a great stock long term, and we think the price is going to go up. So we are going to sell a vertical put spread. We look at the options chain and we look at 25 to 45 days out, or DTE, days to expiration. With Netflix currently trading at $285, we sell the closer to the money put option $275 and we buy the further out of the money $265 option. We put this on in one trade and look to collect about 1/3 the width of the strike in options premium. So it is a $10 wide spread and we are collecting $3.50 or $350 on a $1,000 wide spread for the one contract or 100 shares. We hit the review and send and place the trade. How do we calculate max profit? The max profit is the credit that we receive when we place the trade. In the case of Netflix, we collected $350. We keep this max profit as long as the stock stays above the short strike price of $275 at expiration. How do we calculate max loss? The max loss is the difference between the width of the strikes and the credit received. So in the Netflix trade, we sold a $10 wide spread and collected $350. Our max loss is $10 minus $350 or $650. So you may ask, why would we risk the $650 to put on a trade that only has a max profit of $350? It's because it roughly has a 65% probability of profit. How do we calculate the break even? The break even of a vertical spread is the short put strike minus the credit received. So in the Netflix example, it would be the $275 minus $350, which is $271.50. So the stock price could drop down to that price from the current price of $285 and we still break even. If it stays anywhere above that price, we make money. What are the advantages of vertical option spreads? Let's take a look. First, we can choose our probability of profit. The probability of success is directly tied to the risk. So if we are super confident a stock will go up in price and we want to collect a little more premium up front, we may choose to only have a 60% probability of profit. If we want to be more conservative, we can choose a 90% probability of profit and be almost guaranteed to make a smaller profit. I prefer to stay around 70 to 75% POP, probability of profit, and collect a good premium up front. Another advantage of selling vertical spreads is that we limit our risk. Since we are buying the further out of the money option, no matter how far beyond the short strike the stock price moves, we have capped our max loss. Lastly, vertical spreads allow us to use less buying power and trade larger stocks. Because we are capping our max loss, the broker does not require us to put up a lot of capital to make the trade. They know that we have a max loss and therefore we can cover the loss. This allows us to trade high-priced stocks that would normally take a lot of capital otherwise. All right, guys, thanks for watching. Please remember to comment below, hit the thumbs up, and subscribe so you'll be notified of more videos like this. Keep an eye out for the next one as we will discuss must-know tips for managing vertical spreads for max profit. Also, be sure and grab the free Simplified Options Trading Strategy Guide. I'll put a link down below. It covers the different options strategies, setups, how and when to put them on, max profits, and trade management. It's a great guide to have by your side when trading options. Happy trading, and I'll see you in the next one.